Welcome to this lesson about the Series 65 exam. In this lesson, we will be discussing methods used to determine the value of equity securities. This topic appears under the Analytical Methods and Investment Vehicle Characteristics section of the exam and forms a critical foundation for evaluating stocks and guiding clients in equity investments. There are several approaches to valuing a stock, and each serves different purposes depending on the investor's strategy, time frame, and preferences. In this lesson, we'll cover four main valuation methods. 1. Technical analysis. 2. Fundamental analysis. 3. Dividend discount models, DDM. Or 4. Discount cash flow analysis, DCF. By the end of this lesson, you'll be able to distinguish between these approaches, understand their assumptions, and apply them appropriately in exam questions and in your advisory work. So let's kick it off with technical analysis. So technical analysis is a method of evaluating securities by analyzing market activity, primarily price and volume, rather than company fundamentals. The key assumptions here are all information is already reflected in the stock price. Prices move in trends, you have to assume that, and that history tends to repeat itself. There are common tools that are used with this: charts, line charts, bar charts, candlestick charts, trend lines and moving averages, volume analysis, momentum indicators such as RSI or MACD, and support and resistance levels. This focuses on market psychology, on trading patterns, and on timing entry and exit points to just the right time. So for the exam, just know that technical analysis is a short-term focused kind of analysis, and it's best used for traders and not necessarily for long-term investors. All right, that's technical analysis. We also have fundamental analysis, a little different here. Fundamental analysis seeks to determine a stock's intrinsic value based on the underlying performance of the company and economic factors. Key focus areas: the company financials, their income statement, their balance sheet, their cash flow, also then earnings growth, revenue, debt levels, and profit margins. Economic indicators such as GDP, inflation, and interest rates. And then, of course, industry and competitive analysis. They use different metrics. In this case, ratios. The P/E, which is price to earnings, P/B, price to book, ROE, the return on equity, and the debt to equity ratio. The approach here is you buy undervalued stocks and hold them until the market recognizes their true value. Fundamental analysis is a long-term oriented kind of analysis, unlike the last one. And this is suitable for value investors and wealth managers. Then we have a third one called the Dividend Discount Model, or DDM. DDM is a quantitative method used to value a stock based on the present value of expected future dividends. So there's a formula. This is called the Gordon Growth Model, where P is equal to D1R minus GP equals /fraction D_1 times R minus G. That's a pretty complicated sounding formula, but you need to know the value of the stock, the dividend expected next year, the required rate of return, and the dividend growth rate, and then you're able to figure this out. So some assumptions: that dividends grow at a constant rate, that the investor's return is entirely based on dividends, and it's appropriate for mature dividend-paying companies, so like utilities and other customer staples that aren't really going to go anywhere. So for example, a company pays a $2 dividend, and that's expected to grow at 5%, and the investor's required return is 9%. So you put that into the formula, and you get 52.50. So this is not useful for companies that don't pay dividends, of course. That doesn't make any sense to use them. It's also sensitive to small changes in growth and discount rates, so it might not always be accurate. Then we have the discounted cash flow analysis, or DCF analysis. DCF estimates a company's intrinsic value by projecting future cash flows and discounting them back to their present value using a required rate of return. So there's also a very complicated formula. I would recommend, if you want to figure that out, you can just look that up, where you need to know the expected cash value in any given year and the discount rate, often WACC, or a required rate of return. This is used for companies with predictable cash flows, non-dividend paying stocks, projections, projects, and acquisitions as well, also used in bond valuation. And there are several advantages to this. It's flexible and detailed, and it does account for the time value of money. Limitations, however, it requires accurate cash flow projections, which can sometimes be hard to get. It's also sensitive to assumptions, such as the discount rate and the growth rate. You might assume those things, but if you're not right, well, your analysis is going to be off. So a tip for the exam, DCF is ideal for fundamental analysis and institutional investors that are evaluating long-term investment opportunities. All right, so that's a lot of really good information. Those got those 4 different kinds. So let's recap. Technical analysis. This uses price and volume patterns to time trades, and so it has a short-term focus. Next, we have fundamental analysis. This evaluates financial statements and economic indicators to determine a stock's intrinsic value. So this is a much more long-term perspective. Then we have the dividend discount model. This uses a stock based on expected dividends. So this is useful for mature, income-paying securities. And finally, we have the discounted cash flow analysis. This projects future cash flows and then discounts them to present value. This is used in both stock and bond valuation. So these tools help advisors select investments that are aligned with clients' goals, risk tolerance, and time horizon. And they're crucial to your success in passing the Series 65 exam. All right, so let's go ahead and move on to some multiple choice questions. I'll quiz you and see if you understand what's going on here. Which valuation method is most commonly used to project the future value of cash flows? A. Technical analysis. B. Fundamental analysis. C. Discounted cash flow. Or D. Dividend discount model. The answer is C, the discounted cash flow. Which analysis method is most focused on historical price patterns and volume? Is it A, technical analysis, B, fundamental analysis, C, dividend discount, or D, discounted cash flow? The answer is A, the technical analysis is the one that focuses on historical price patterns and volume. The dividend discount model is most appropriate for A. Fast-growing tech stocks, B. Small cap companies, C. Mature companies with stable dividends, or D. IPOs with no dividend history. The answer is C. Mature companies with stable dividends. Which method uses ratios like P/E and ROE? Is it A, technical, B, fundamental, C, DCF, or D, ADR analysis? The answer is B, fundamental. In the DDM formula, what does G represent? What is one of the things you need to know? A, the gross income, B, the growth rate of dividends, C, government bond yield, or D, goodwill adjustment. So in this case, it stands for B, the growth rate of dividends. So DDM is based on dividends, so you need to know the growth rate. Which valuation method is most sensitive to changes in the discount rate? Is it A, technical analysis, B, P/E ratio, C, DCF, or D, price to sales ratio? This method is the DCF. All right, an investor looking for short-term entry and exit points would most likely use which of the following? A dividend discount model, B, technical analysis, C, fundamental analysis, or D, DCF. In this case, you're looking for B, technical analysis. It helps you have those short-term entry and exit points. If a stock's intrinsic value is higher than its current price, what might a fundamental analyst recommend? A, sell, B, hold, C, buy, or D, convert to ADR? The correct answer is C. They would recommend that you buy. This is a good time to buy. Which valuation method is best suited for companies not currently paying dividends? Is it A, DDM, B, technical analysis, C, DCF, or D, the P/E ratio? The correct answer is C, DCF. Which type of analysis assumes that price already reflects all available information? Is it A, DCF, B, technical, C, fundamental, or D, dividend discount? The correct answer is B, technical. Which measure indicates how far returns deviate from the average return? Is it A, alpha, B, Sharpe ratio, C, standard deviation, or D, beta? In this case, it's C, standard deviation, how much they deviate from the average. All right, 5. What does a beta of 1.2 indicate? A, the security is 20% less volatile than the market. B, the security moves independently of the market. C, the security is 20% more volatile than the market. Or D, the security has no systematic risk. The answer is C, the security is 20% more volatile than the market. So it's greater than 1 by 20%. So that's how you know that. All right, let's round this out by doing a few open-ended questions. Why might an investor prefer fundamental analysis over technical analysis? Give that some thought and give me your answer. All right, it's okay if it's not an exact match to this, but something like this. Fundamental analysis provides insights into the company's financial health and long-term prospects, helping investors identify undervalued stocks based on real-world performance rather than price trends. What are the limitations of the dividend discount model when valuing growth stocks? So think about that for a minute, and then give me your answer. All right, so growth stocks often reinvest profits and don't pay dividends, making DDM inapplicable. Also, DDM relies on stable dividend growth and predictable payout history, which growth stocks often lack. How does discounted cash flow analysis incorporate the time value of money? DCF projects future cash flows and discounts them back to their present value using a required rate of return, allowing analysts to assess what those future earnings are worth today. What is the main tax advantage of an ISO compared to an NSO? Is it A, tax-deferred income, B, no taxes at all, C, long-term capital gains treatment if the holding rules are met, or D, a tax deduction for the company? The answer is C. You get those long-term capital gains treatments if the holding rules are met. How are Treasury bills, or T-bills, typically issued? A, at a premium. B, at par value with semi-annual coupons. C, at a discount and mature at par. Or D, with adjustable rates. So in this case, they are issued at a discount, and then they mature at par value. So then the difference is what the investor pockets. Which of the following is a short-term unsecured corporate debt instrument? A short-term unsecured corporate debt instrument. Is it A, a certificate of deposit, B, commercial paper, C, a treasury bond, or D, a municipal note? The correct answer is B. It's that commercial paper that we're talking about here. Which of the following securities is considered risk-free at the federal level? Is it A, commercial paper, B, treasury bills, C, negotiable CDs, or D, corporate bonds? The answer is B. Treasury bills, or these T-bills, they're considered virtually risk-free. They're backed by the full faith and credit of the U.S. government. So they're one of the safest investments out there. Which type of CD is typically traded in the secondary market? Is it A, traditional bank CD, B, a callable CD, C, a brokered CD, or D, an insured CD? The correct answer is C. It's a brokered CD that are traded on that secondary market. My next question is, why do most commercial papers mature in less than 270 days? A, to align with fiscal quarters, B, to avoid SEC regulation, C, due to FDIC regulations, or D, to receive higher yields? In this case, the answer is B. They're trying to avoid SEC registration. Which economic indicator measures inflation at the consumer level? Is it A, GDP, B, PPI, C, CPI, or D, the Fed funds rate? In this case, it is C. It's CPI. It's that basket of goods that they look at and see, oh, are these going up? Are they going down? This is a very consumer level indicator of where the market is headed. Which global factor most directly affects an investor that's holding foreign assets? Is it A, U.S. monetary policy, B, currency exchange rates, C, the federal budget, or D, unemployment rates? The answer is B. It's those currency exchange rates. So if you hold those foreign assets, the currency exchange rate has a larger impact on your investment. And finally, for this section of the test, if a country is experiencing a recession, which of the following might it use to stimulate growth? A, increase interest rates, B, cut government spending, C, raise taxes, or D, lower reserve requirements? So in this case, the only thing that's going to help the economy grow is by lowering those reserve requirements, D, so the banks don't have to hold as much in reserve. They can lend more out to investors. That can help get the economy going again. Which of the following is true of a trade deficit? A, it means exports are greater than imports. B, it usually strengthens a country's currency. C, it can reduce GDP. Or D, it decreases the federal budget. In this case, it's C, it can reduce GDP because of the problem with more money going out than is coming in with goods. What does the Federal Reserve typically do in response to rising inflation? A, reduce interest rates. B, increase the money supply. C, lower reserve requirements. Or D, raise interest rates. In this case, they raise interest rates. They want to get money out of the economy because of inflation. Which of the following offers protection against inflation? A, a corporate bond. B, TIPS. C, a treasury bill. Or D, an asset-backed security. The answer is B, TIPS. It's right. The I is for inflation. So yeah, it adjusts for inflation as time goes on. Which of the following fixed income investments is backed by a pool of consumer debt? Is it A, TIPS, B, treasury bonds, C, asset-backed securities, or D, convertible bonds? This is a C. ABS, or asset-backed security. Those are made up of pools of consumer debt of various types. What is the primary risk of high-yield corporate bonds? Is it A, prepayment risk, B, deflation risk, C, credit or default risk, or D, liquidity risk? The answer is C, credit risk, also known as default risk. Question 1. Which of the following is a systematic risk? A, a company being sued for fraud. B, a recession that affects the entire market. C, a company's CEO resigning. Or D, a factory shutting down due to labor strikes. In this case, it's B. Systematic ones affect the entire market. So a recession in the economy that affects the entire market would be B, something that is systematic. What type of risk can be reduced through diversification? Is it A, market risk, B, interest rate risk, C, credit risk, or D, systematic risk? So for this one, it's C, credit risk. The other ones are systematic risk that cannot be diversified away. Which of the following is a lagging economic indicator? A, stock market performance, B, unemployment rate, C, retail sales, or D, manufacturing orders? In this case, it's that unemployment rate that looks back to the past that confirms trends in the market. Which type of stock option allows the employer to deduct the benefit on their taxes? Is it A, an ISO, B, an NSO, 3, an ADR, or D, preferred stock? The answer is B. An NSO allows the employer to deduct the benefit on their taxes. Which type of stock typically pays a fixed dividend and has no voting rights? A, common stock, B, convertible bonds, C, preferred stock, or D, warrants? The correct answer is C. It's that preferred stock that gets that fixed dividend but no voting rights. All right, how did you do? If you're feeling really good about things, You can go ahead and move on to the next lesson. If not, please go back and review before moving on. Our next lesson is going to be about equity public offerings, IPOs, secondary offerings, and SPACs. And that is all for our lesson for today. Thank you very much for listening.